Right. Looks like we are live. Good afternoon, everyone. Can you hear me? Just drop a note, a few of you, if you wouldn't mind, in the question box if you can. Just make sure that you can hear us, and see the screen as well with the presentation on it. Welcome, everyone, to the GROW Mentorship Series, Condo Guideline Updates and the Impact to Your Market. I'm your host, Joanne Theriault-Fazio, Divisional Sales Director for the Midwest at Origin Point, and your GROW Mentorship Director. I've been with rate companies for 18 years and have served as the mentorship director for GROW since the start of the program about 7 years ago. Now, on to the reason why we are gathered here today. For those of you joining us for the first time, GROW is a rate company's employee resource group designed to help empower and support women and the men. And today's call is actually opened up to our referral partners as well. So let's do our first poll question. Natalie, if you wouldn't mind pulling that up for us. We would love to know our audience. And our first question is, are you on the lending side or the real estate side? Just to get an idea on who is here with us today. And if you are both, just pick one, because that also may be the case. And then our second poll question, because it will just lead you into the second one, is, have you ever had a condo project denied? Yes or no? So if you could just click those two and submit. I don't know which one of you just chuckled, but we will talk about all of that in a bit. But anyway, yeah, if you just go ahead and push submit, and then, ooh, Natalie, I can't see the results now. I don't know if you can.
Oh, okay. So it looks like responses are still trickling in. 57 responses, 98% are lenders, 2% real estate.
Okay. All right. How about that condo project denial question?
And then condo project, 77% have said yes, a project has been denied, and 23% have said no.
This was the most confusing thing.
Oh, if everybody could just mute themselves. Can you mute everybody, Natalie? Minus us. Thank you. All right. Okay, so looks like polls are in. So yes, if you are here today, good possibility you've had a condo project that has been denied. So you're going to gain more knowledge here today, which is great. And maybe you're here because condos have become the bane of your existence. Either way, our panelists today will have you feeling better about your condo knowledge by the end of the call. And with me today, I have Amy Ramon, Divisional Underwriting Manager, Condo Department East for Rate Companies, and Maddie Erickson, Divisional Manager of Condo Underwriting for Guaranteed Rate Affinity, both of whom have been with rate companies for, I think, almost as long as me, 14 years, right? About for both of you, long time. And so if you do have any questions during this call, we most likely will not be able to get to all of them, just because there's a lot that we're going to cover today, and we want to make sure we get through it all. But what we will do is we will send out an FAQ answering a lot of those questions for everybody after the call, which will be really great for everybody to have in hand. Both Amy and Maddie have done a few GROW Mentorship Series calls with me over the years, and that is because condos continue to be a hot topic. We have seen so much growth over the years at rate companies, and all of our rate companies are leaders in the condo market, and that's in large part to these extraordinary women. And now I will turn the call and the presentation over to them.
Great. Thanks, Joanne, and thanks for having us here. I'm Amy Ramon, and I'm going to just start with an agenda. We have a lot to unbox today, so I'm just going to briefly go over what it is that we're going to be discussing today. So we're going to start with a little bit of background. To understand today's condo landscape, it's very, very important to know why we got here. So we're going to cover that for you. And in addition, we're going to talk about the biggest impacts and updated requirements to the condo guidelines. We got some great condo data that we've compiled to be able to give you a little bit of insight into the market. HOA insurance is one of the biggest topics lately, so we have a whole segment just for that. Then we'll dive into the condo landscape today to get an idea of what the requirements are. And then we're going to go ahead and end it with partnership and processes, which is, I think, the best part of this presentation.
All right, well, I guess it's my turn now. Awesome. So thanks, Amy, and thank you, Joanne, to you and your GROW team for inviting Amy and I here today, because we are talking about our favorite topic, condos, right? So condos are one of the most niche and misunderstood property types of the housing market, but they're a major business opportunity if you know how to manage the risks early on. So we're going to start with a little bit of condo background and why that shifted in recent years. And that's because of the picture on your left here. This is Champlain Towers in Surfside, Florida. And this was a national wake-up call. It exposed serious vulnerabilities in aging condo buildings, many of which across the country are over 20 years old now. And so since then, there's been growing concern about the structural integrity, the maintenance of similar buildings across the United States. And a fun fact is, as of 2024, condos make up 13.1% of the national housing inventory. This is above historic norms. And so, condos are most common in big cities, but they can exist everywhere. And they really come with their own unique risks that require closer scrutiny. Go ahead to the next slide, Natalie. All right. So after Champlain Towers tragedy, Fannie and Freddie, they moved fast. So by October of 2021, just 4 months after the collapse, they rolled out temporary guidelines that this was a complete bombshell to the condo lending world. The problem was that these rules that they implemented weren't always clear. We were scrambling as lenders, and it led to a lot of confusion, a lot of frustration. But fast forward to September of 2023, the agencies finally came together and locked in permanent mirrored guidance, which brought some much needed clarity and consistency, but it also came with tougher requirements. So today, lenders can't just skim the basics. This is not 2018. Love going back to 2018 condos. But, we have to chase down a mountain of docs before we can even say whether a condo project is financeable. Let's go ahead to the next slide, Natalie. So if the critical repair aspect wasn't enough, right? 2023 had one more curveball, and that's going to be the insurance space. Condo associations started seeing premiums climb and their coverage shrink. And this has been making it much tougher to secure protection that's so important for HOAs and lenders. On top of that, new agency databases were introduced, and this meant that us lenders had to take on more responsibility when we evaluate condo projects. And all of this has really added cost and time to the mortgage process in general. So that's making condo loans more complex than ever to close. So we're going to circle back to insurance later since it deserves its own spotlight. But for now, we're going to pass it back over to Amy to break down the biggest condo changes and the impacts they've had to the market.
Great, thanks. So biggest impact and changes. So everything that Maddie has just gone over has had a significant impact on the way condos are currently underwritten. So the biggest components that have been impacted are critical repairs, HOA insurance, and state mandated requirements. Critical repairs is a challenge for lenders. Projects all the time have different ongoing projects that they're working on within the associations, replacing roofs and replacing stairs and updating balconies and that kind of thing. So it's our job as lenders to review those ongoing projects to determine, is it critical in nature or is it preventative and routine maintenance? So there are a tremendous number of documents now that are needed that were not before. HOA insurance, as Maddie indicated, we have a whole segment just for that, but HOA insurance insures the association, the lenders, and the unit owners. So everyone involved in a condo transaction, we have to review the HOA insurance in greater detail than ever before. State mandated requirements, I'll get into that in just a moment, but the state mandated requirements are local municipalities or state required inspections and inspection programs that have been put in place to be sure that condo projects are maintaining their projects in compliance with requirements. So we're going to go into updated condo requirements now, and these are the biggest changes and the increased documentation that lenders are required to review when underwriting condos. The biggest one are all mechanical or structural engineer reports or inspections within the last 3 years must be provided to the lender for review. And I think that's very important to note that here is that the lender has to review them. So if there's been an inspection report completed within the last 3 years, they can't just tell us, yes, we've had one, but nothing was wrong. It was fine. That's not enough. The agencies and investors require us to review those. The lenders have to review them to determine the terminology and the guidelines published by Fannie Mae and Freddie Mac are met. So we will need to see all of those. And that was new. When this all came out in 21 going into 23, these were not documents that lenders were required to review for condo underwriting. So there was a lot of education, a lot of training that went into how do we interpret these inspection reports. In addition, special assessments, proposed or ongoing special assessments now need to be dissected and reviewed if they are present within any condo association. This protects, again, the lender, the project, the borrower, everyone within the loan transaction. Special assessments are typically issued when the HOA does not have the funds available to be able to support updates or projects that are needed. It could be a response to a critical failure, or special assessments can also be for maintaining the property, right? But they don't have the funds to do it. So they could levy a special assessment against unit owners just so that they can update the cosmetics in a project. Or it could be in response to critical failure where they don't have the money and they need to make an immediate repair. So we have to review those now. So today, lenders have to review many, many more documents than they did before. And this applies to both limited and full reviews. So it's not just full reviews. The type of review, both limited and full, require nearly the same documentation. Special assessments, inspection reports, those are required under both review types. So the amount of money that a borrower is putting down is not going to relieve a lender from reviewing these documents. So I want to go over some of the documents that lenders need to review and give you a little bit of information about those. So completed condo questionnaires, specific forms, and the agency 1076 forms are required for condo transactions. We have to review all the information on them and make sure that the project is compliant. It is important to note that there are many different types of condo questionnaires. There's, if you're in the industry and you know what I'm talking about, you got HomeWise, you got condo certs, you have First Service Residential. They're proprietary questionnaires all over the place. We can take those. We don't need a lender-specific form in order to comply with the guidelines. So we can look at all questionnaires. The agency 1076 form, Fannie Mae and Freddie Mac created and included also an addendum related specifically to their updated guidelines for critical repairs and special assessments. Budgets have definitely been something that we're used to reviewing under full review guidelines. However, with the updated changes to the guidelines, budgets and financial documents could be required not only under limited reviews, but full reviews as well. If an HOA has a special assessment that they levied against the unit owners, their financial documents need to be reviewed to determine financial viability. This includes reserve studies. So in some cases, you will be requested to provide reserve studies, especially if you're in Florida. They have their SIRS reserve study that is technically an inspection, and that would have to be provided, which leads me to inspection and engineers reports. Again, these are completed within the last 3 years. So it's very, very important that when we get those documents, we identify the date. There are times that we get documents, inspection reports that were completed in 2019. We don't want to see those. Only within the last 3 years. That's what we're looking for. That's the requirement. So next we get into something that we really haven't reviewed prior to the updates to the guidelines, which are HOA meeting minutes. HOA meeting minutes are challenging, to say the very least. It is the one type of document that I would prefer not to look at. HOA meeting minutes can open Pandora's box, but they are required. When we have associations or property managers that do not want to provide the information necessary for the lender to comply with guidelines, it's then up to the lender to obtain additional documents to do their own assessment of the project to see if the project complies with guidelines. And those are HOA meeting minutes. And I can tell you, we get 6 to 12 months of HOA meeting minutes. And if we're dissecting these meeting minutes, we're looking at everything. We're looking at every indication that there could be something going on in the project because those documents are delivered to the agencies, they're delivered to the investors, and they will dissect them just as closely as we would. So ideally, we would like to get the other documents because the meeting minutes are not a required document. It's only required if we cannot obtain answers to the required questions based on the other documents provided for review. Special assessment information and letters. When there's an active or proposed special assessment within a condominium project, we have to determine multiple different things. But most importantly, we have to determine, is the special assessment related to critical repairs? That's the big question, right? And then the secondary question that's very, very important is delinquencies. Are the unit owners paying those special assessments? But we have to get the documents for special assessments for active and proposed special assessments. So if any of your documents that were provided for review indicate that there's a special assessment proposed or active, be prepared to obtain additional information. As I said, these are documents that are needed to comply with the updated guidelines, and a lot of them are much newer to us as lenders prior to the updates. So we're going to go then right into some additional information on these inspection reports. Again, if completed within the last 3 years, the inspection report has to be conducted by licensed engineers or architects. That's what we're really looking for, right? Maintenance, the maintenance guy at the association walking around the project, taking a look at everything and then giving the HOA report. That's not the inspections we're looking for. We may look at them if they're identified in meeting minutes and they can't answer the questions that are needed to get us where we need to be, but those are not what we're asking for. We're asking for inspection reports, mechanical or structural, completed by licensed engineer or architects. One of the really crazy changes that we've identified in the market right now are state mandates. So as you can see here on this slide, we've called out just a couple of the different states that we do a lot of condos in that have state mandated requirements. Florida is one of them. So any of you that do loans in Florida, I'm sure you're very familiar with it, but there is a Senate Bill 4D that was introduced and requires milestone structural integrity reports completed at different intervals, depending on when the projects are getting their initial, I believe it's 9 years, but they have to get them done periodically. That SB4D is coupled with a SIRS, S-I-R-S, that's a Structural Integrity Reserve Study. In the state of Florida, the SIRS have to be completed, and not only does the HOA need to set aside reserve funding on their budget, but then they also have to adhere to their SIRS to fund additional reserve funds to cover the requirements of the SIRS, the SB4D. In addition, Florida has a 40 and 50-year milestone inspection report that is required. So it makes it a bit challenging. Just more documents for us to review. In the state of California, big news, Senate Bill 326, not to be confused with Senate Bill 371. I believe that's the one.
721.
Blank there. 721. Thank you, Maddie. I couldn't remember right off the top of my head, but the Senate Bill SB 326 is a bill that requires elevated elements, exterior elevated elements to be evaluated within condo projects that qualify for that. We call it the balcony law. These are going to be balcony inspection reports that have to be provided to the lenders for review and determination on whether or not that project meets guidelines. In Illinois, we have a Chicago facade ordinance and an exterior wall program. It's pretty big. I don't know for you, those of you that have done loans in Chicago, there was a period of time, couple years, everything to me is a couple years ago, but maybe within the last 10 years, the water towers that were rusting out on top of these buildings in Chicago were falling. They were falling off of buildings. So, Chicago had to enforce different inspections on the projects within that area to make sure that they were properly inspected. New York, that's a whole challenge all in and of itself with their local law 11 and facade inspection safety programs. So these are just a few examples of the different introductions to the different states in enforcing inspection reports on condo projects due to aging infrastructure and the concerns with safety and the maintenance of condo projects. So with that, Maddie is going to go ahead and start talking about condo data that has been collected. So
actually, I'm going to jump in really quick first, Amy, just from a sales perspective, just on a few things, because you covered quite a bit. And since we have salespeople on here, we want to be able to tell them, like, what does this mean for you? So obviously, Amy just went over a whole bunch of changes. Like, that all probably is super overwhelming. And so from a sales perspective, what I want to say is that I'm obviously in a market that does a lot of condos. Our division does a lot of condos. And what we have found offers the most success is to collect as much information upfront as possible. If you are a realtor on this call and you're taking a listing, ask the questions. We'll send some information out on what some of those great short questions are, but sometimes asking the unit owner isn't always enough. You really want to get into it with the HOA to try to make sure that you're actually being provided information. I had a call with an agent this morning, actually has a listing. It's one of 4 that are under contract in a 61 unit building, and there is a $1.8 million special on it. That's a lot of money. What is it for? It's for facade work. What information did he get from the unit owner up front? Not all of that, part of it. And so having all of that information would have put them down a much better path to get that property under contract because that building is currently non-warrantable. So getting a lot of this information up front, working with your lender partner, super important. We have a lot of capability at rate companies to look up this information. We have this amazing condo department. As you can see, we have 2 components of it right here with all of this knowledge that can really help us make sure we're setting your listings up for success, your buyers up for success, the availability on the weekends to make sure that we're asking the right questions and that sort of thing. So just wanted to jump in there just a little bit from a sales perspective on what we would do as a salesperson to try to get through this fun condo situation that has become the thing the last few years. And with that, I will have Maddie go into condo data.
It's hard, sometimes being in operations, it's hard for us to understand the sales side of things. So Joanne, thank you so much for sharing that. For all you Family Feud fans out there, survey says, Natalie, you can go to the next slide. So survey says HOAs are under a significant amount of pressure. Okay. A lot of this has to do with critical repairs and insurance, but to know that HOAs may not have engineers or attorneys on call. They're being asked to certify structural integrity and financial health, and these may not be things that they're equipped to deal with. But this survey really shows how much pressure condo communities are under with these requirements. On the left, we look at the top concerns, right? Over 70% of associations worry about liability when they answer lender questions because it goes beyond their knowledge and their expertise, right? In the middle, you can see the impact as well. About 1 in 6 communities said that they've had delays in lender approval. Another 15% had loans denied because of things like insurance deductibles or inadequate coverage. On the right, when denials do happen, insurance is going to be the number 1 culprit. So high deductibles, inadequate coverage, even affordability of coverage are really driving a lot of these issues. Of course, reserve requirements and ongoing maintenance projects follow close behind. But the big picture here is pretty clear, right? Associations like lenders are very overwhelmed by this. Lenders are frustrated and borrowers are kind of stuck in the middle. And you'll notice because insurance is at the heart, and a lot of these pain points, we're going to turn it back over to Amy to talk more on insurance. So unpack it for us.
Great. Insurance. Wow. I gotta tell you, every single day there are multiple insurance concerns that are brought up. Primarily, insurance has been impacted, right? I'm going to kind of go over this. I'm not going to read everything to you, but it's definitely something that is important to understand. So due to all of these different components that are going on in the environment and the economy today, we have inflation, we have rising costs of goods and services, natural disasters, average age of condo buildings, which I think we've talked about a couple times and we'll continue to talk about, and the quality of the building components. Due to all of this, these rising repair costs, those aging infrastructures, all of this, insurers are responding. And they're responding with higher premiums, larger deductibles, or by dropping coverage altogether. There was a couple insurance policies that I've reviewed recently that the coverage was denied by an insurance carrier because of the fire panels that were installed within the project. They are known and have a history of catching on fire, and it is a liability. So HOAs, there are multiple different reasons why HOAs are struggling with insurance. But these are a lot of the key factors that have led to where we're at. So I'm going to go into some statistics for you just on how the insurance environment has impacted condo associations. So a survey was conducted, and based on that survey, this is what we know. This is what we have found out. 91% of condo HOAs confirmed that their property and casualty insurance premiums increased at the last renewal. That's insane. I can give you an example. I was reviewing condo insurance. I want to say this was about 6 months ago or so. And the association, I was reviewing their budget, the same exact coverage from their previous year to their next year. Last year, the year before, it was $53,000 was their annual premium for their insurance. To get the same amount of coverage into the next policy period was $352,000. The $300,000 increase for the same coverage. So the HOAs are really being impacted by this financially. So that's just one example. 24% had higher deductibles forced by the insurer. So not all the time deductibles are an HOA's election. They're not the ones saying, hey, increase our deductibles and make our policies ineligible. That's not what's happening. That's not what's happening. The insurance providers are forcing them to increase their deductibles. 50% increased individual assessments to cover the increase on their policies. HOAs are made up of the unit owners. It's not a ghost corporation sitting out there somewhere, filtering money in. HOA dues is what pays the association's bills. They pay the insurance premiums. They're paying for the repairs. So when insurance premiums increase, unit owner dues increase, and that affects the borrowers and the current unit owners within the project. 43% used other methods such as increasing deductibles. So not only are they in some cases being forced to increase their deductible, but some are electing to have a higher deductible to offset costs. Higher deductibles on their insurance policies could reduce the cost for the policies themselves. 7%, and I'm sure it's higher today than when the survey was conducted, but 7% of associations had to impose a special assessment. It was such a sticker shock to the associations. They budget. Most associations put their budget together at the end of the previous fiscal year. So you're looking October, November, they're putting together their budget to figure out their costs for the next year. So when you mid-fiscal year have an increase in your insurance premiums and you don't have the money to do it, especially in my example of a $300,000 increase, where do you get it? You have to levy a special assessment. So unit owners then not only pay their regular HOA dues, but then they're also on the hook for paying a special assessment on top of that. So it's just a little data so that you can see exactly the impact that all of the insurance issues are having on the associations and the unit owners directly. So now I want to talk about the top concerns for condo insurance. So in response to the rising insurance costs, the HOAs, they're trying to maintain policies and being able to afford those policies. But in order to try and mitigate that higher cost, the insurance policies are being changed, right? So that they can afford them. So we're seeing higher than 5% deductibles on HOA property insurance policies. And this is not only just the per occurrence deductible that is just a standard across the board, but we are also seeing per unit deductibles. So an increase in the insurance policies, trying to move the deductible costs onto the individual unit owners, and those per unit deductibles then end up being higher than the 5% required currently by agency guidelines. We're seeing more and more co-insurance policies on HOA insurance. Co-insurance in and of itself, if we confirm 100% coverage, is not ineligible, but more documentation is necessary to make sure that it's compliant. But co-insurance provisions allow the HOA to obtain coverage with different requirements, lower percentage costs associated with their policy premiums, and they have to carry a certain amount of insurance in order for those provisions to be in place. I think I see this more often. I've been doing this 14 years, and I think I'm seeing it more often than I ever have before, is actual cash value coverage. We primarily see this when it relates to roofs. It'll say actual cash value for roofs greater than 12 years old or greater than 15 years old. Actual cash value, but we're seeing it more and more just on the regular coverage, actual cash value. That is a depreciated actual cash coverage, not replacement cost. So in the event that something takes a peril or something happens within the project that needs coverage, they're not going to pay the full replacement cost of it. They're going to pay the depreciated amount at actual cash value. Reduced property insurance coverage lower than the 100% replacement cost value. I have a very awful example to share with you, but I was reviewing an insurance policy a couple weeks ago. Project was on Fannie Mae's ineligible list due to inadequate insurance. And it was wild. When I looked at the insurance certificate itself, the HOA had $5 million in coverage, $5 million. When we looked at their previous coverage and the replacement cost estimator, their replacement cost value was $179 million. $179 million is what it would cost to replace that project, and they elected to only have $5 million in coverage. So we're seeing that not so drastic, not that big of a drastic difference in coverage, but we're seeing it across the board, across the nation. Different lowered coverage amounts versus the replacement cost value of those policies, what they actually need in coverage. In addition, one of the biggest issues that we see is limited or reduced coverage for specific perils. Most commonly, wind and hail. Same kind of situation. HOA has a replacement cost value for their property insurance, but they elect to carry a lower amount in wind and hail coverage, and that's not okay. All perils required to be carried on an HOA policy have to be equal to 100% of the replacement cost in order for it to be acceptable. So reducing those perils is something that we've seen as well as a way that HOAs are trying to maintain their policies and mitigate their costs. So what solutions do we have? That's what I'm going to talk about now. I don't have great news for you. Solutions for HOA insurance are few and far between. Unless the HOA brings their policies into compliance with the guidelines, financing is extremely limited. Most investors across the nation are going to comply with standard published agency guidelines, and the requirements are black and white. This is what they need. So yeah, maybe we have some broker lenders available, but we definitely are seeing more non-QM, non-warrantable options that might be willing to take on some of these insurance. Not all of them, but we're definitely getting more of those opportunities today than we were before. The best option for us, what we see is education. Educate, educate, educate. The more you're involved and identify the ineligible characteristic, which in this case, we're talking about insurance, and notifying the HOA, hey, that you need to bring this into compliance. You're not adequately covered. Your unit owners aren't covered. The cost that the HOA will bear in the event that they're not properly covered could be substantial. So we would like to make sure that we're educating the HOAs and trying to convince them to obtain adequate insurance. That's the best path forward when we're running into insurance issues. So next, I think, Maddie, you're on deck now to talk about some agency requirements.
Yeah,
Feels
agency
Joanne wants to
requirements.
jump in really quick though, because you talked
Joanne,
about
you go
education,
ahead.
Amy. Yes.
Oh, yeah.
But that's where we can come in though too. Like you're all here today, so go out, educate your borrowers, educate your referral partners, educate HOAs. I think over the course of the last 2+ years, our companies have educated HOAs a lot, probably more than they ever wanted to be educated on, getting schooled on insurance and whatnot in their lives. But the good news is that interest rates have come down. And if rates come down, there was a article in NAR that talked about if rates come down to around 6%, that could stir another 550,000 people who could potentially purchase and afford a home in the next 12 to 18 months. The thing with condos and insurance being more expensive is that we really have to make sure that we're qualifying those people appropriately. So there's a lot of factors that go into this. I know that both Amy and Maddie are throwing like the hard stuff at you, but we promise that there will be some sunshine and rainbows at the end of this call as well. So just wanted to jump in and say those few things, and I'll kick it back to Maddie.
Well, thanks, Joanne. Yeah, I know it's we're being negative Nancy's right now. It kind of stinks, but we just want to be realistic with everybody. But I think the positive silver lining at this point is you have condo subject matter experts available to you. So we're going to be talking about agency requirements. This is really about where we are right now with them. And so Fannie Mae and Freddie Mac, as we've indicated previously, is that they've tightened their expectations. So every condo loan today runs through their project databases. It's really one of our first steps. And really the project databases and the statuses of these projects is consistency between lenders, right? Where they're eliminating the competition and they're being a little bit more transparent about what's going on. It's kind of a helpful aid, if you will. But depending on the status of a project on one of these systems, it's really going to mean whether or not there's more responsibility or more scrutiny that we have to apply. So here's how it breaks down. So Fannie Mae, they have CPM. So this stands for Condo Project Manager. And it's basically, again, the system that we use to check if the condo is eligible right from the jump. Right. This is a living, breathing databases. Statuses change. Amy, I think what did Fannie Mae say, like is 5-6 times a day, maybe on one project. It's kind of insane. But this is a very helpful database because we get to see the status right off the bat. We get to see what Fannie Mae's opinion is on a project, whether it's good or it's bad. And we have the ability to communicate certifications or with Fannie Mae through this database as well to get them docs, to get projects off of the unavailable list. On the Freddie Mac side, we have Condo Project Advisor, and this harbors the project assessment request. And this is Freddie's way of gathering info and advertising info about condo projects and how it evaluates to their guidelines. So these being the databases, what we're going to look at next is what's changed recently in how they connect with underwriting systems that most of you loan officers probably live in every single day. So Natalie, go ahead and switch it to the next one. So the next layer is integration with these underwriting systems. So Fannie Mae CPM is going to directly integrate into Desktop Underwriter or DU, which means that if a project is in CPM and it has a status, whether it's approved or unavailable, it's going to show up on your DU findings or your AUS findings, and that's going to give you immediate feedback on eligibility. For Freddie Mac, Condo Project Advisor is now connected with LPA or Loan Product Advisor. So when you run this loan through LPA in the system, it's automatically going to tell you the project status. So What I think is really cool about this is that this integration really gives lenders, and I think loan officers, really faster answers, but also a little bit less wiggle room, especially if the project doesn't meet requirements, but it's going to give you the heads up early on, right? So we're going to move into why partnership and processes are really more important than ever. And it's because, go ahead to the next one. And it's because condo deals are really going to take extra coordination, right? We're kind of always subject to third-party information, right? It's a lot of hands in the cookie jar. But really, the key takeaway here is the earlier you loop in our teams, the smoother things are really going to go. And it's really not checking a box here, right? It's about adopting the right process, being available to you guys so you aren't hitting last minute roadblocks. So breaking it down, if you're listing a condo, and Joanne, I think you touched on this earlier, when you're listing a condo or you're working with a buyer, really the best thing you can do is get ahead of these requirements. And that's going to mean setting expectations early with your borrowers, right? Maintaining trust, showing them that you're on top of the risks and the rules, right? Create smoother transactions by checking condo eligibility up front, and open more doors, right? Because the earlier that we vet the project, the more financing options stay available. But here's the real payoff, right? You are going to become the hero, right? We're just, underneath the stairs, red stapler basement, office space kind of people, right? But you guys are going to become the hero, right? You're going to be the go-to resource for your clients when condos get complicated. And, it's going to be awesome because you're not just going to hand off the problem to, your teams. You're going to solve it, right? And you're going to become educated and you're going to be the subject matter expert. Because condo lending is not really about dodging risk. It's about managing it smarter than your competition, really. So that is why Amy is going to take it back over, and she's going to tell you about some really awesome, fantastic rate company perks that come with the condo team.
Great. And as Joanne has said and Maddie has said, this is a lot of information coming at you, right? We're not trying to train you to be condo underwriters. I think the importance here is to be educated. Loan officers, realtors, everyone has to communicate with each other. And the most important parties involved for sure are going to be the buyers, the clients, right? They need to be educated and kind of kept in the loop. So the more you know about everything that's going on will help you a little bit to understand the different conditions that might be coming back or the delays on your files. So we definitely want to just make sure that you don't have to remember all this. We're just trying to give you a little bit of education so that we can help. And this is how we can help even further. Rate Companies has a dedicated condo underwriting team, increasing staff as quickly as we can to accommodate, the complexities in the condo underwriting space right now. We have great partnership with the agencies. Rate Companies has helped Freddie Mac pilot multiple of their programs over the last decade, as well as Fannie Mae. So we definitely work very, very closely with them, vetting projects and that kind of thing. But the most important thing on this screen that I think that I'm going to talk about is pre-qualification reviews. Pre-qualify your projects. If you are going to take a listing in a project, see if the project's eligible up front. See if you can work with the seller and the HOA to obtain as many documents as you can, and we will pre-flight it. We will look at any of the documents for any condo project that you want us to. Send them on over. Let us take a look at them. Let us advise on any potential obstacles, pitfalls, statuses on the Fannie Freddie list. We want to be able to do this. And it could be a simple insurance review document. It's one of the biggest reasons that projects get declined. Get a copy of the insurance, send it over. Let us take a look at it. What that does, and what Maddie was talking about, is setting those expectations. Is it makes for a smoother process. So we can do all of this in the background as loan officers, as realtors, and your underwriting staff here at Rate. What we can do is we can get all the dirty stuff done first. We can work through all the hard stuff so that when a loan is originated, it's smooth. We got everything that we need, and there's not really that much of a delay that the borrower has to experience with pre-qualification reviews. We at Rate Companies have had enormous success with removing ineligible product statuses, several a week, dozens sometimes, where we will look at the project itself and try to get it off the list. Let's get more information. Let's submit it to the agencies and get that status overturned, because it will open up lending opportunities for the borrowers that are looking to buy in that project. They're not just restricted to broker lenders. They're not just restricted to non-QM and higher rates. Let's get them back into compliance with Fannie Mae and Freddie Mac. Goes back to all that education that we've been talking about here. We have dozens of investor options. So yeah, there will be projects that will not comply with Fannie Mae and Freddie Mac guidelines, and we'll work it out. We'll do our best. We'll try to bring them into compliance and help the HOAs that way, but we do have a ton of non-QM and non-warrantable options that we've vetted out a lot of the non-warrantable components, and we do have options, not just brokers, but we have many, many options. So let's talk about that pre-qualification review process a little bit. We can pre-qualify any projects that you want us to, any of them, just bring them on. Let's take a look at them. So we have to review the condo project documents and identify any potential ineligible characteristics, right? So we have to, our team, our condo team, our dedicated underwriting team will assist in providing information on obtaining the documents and the information necessary to resolve those possible obstacles. But the really great thing about the pre-qualification review process is you gather the documents, you get them over to a loan officer at Rate Companies. They have connections to our departments here. We'll be able to take a look at them in the condo department. And the great thing is that once we have the project fully reviewed, we're going to give you all the options. This is what we have. This is what we can't overcome. So what are your options? What are your next steps forward? Can we get the loan done? And if we can, how do we get that done? So that's a real benefit of pre-qualifying projects. So here I want to spend just a couple minutes before Maddie goes into our wonderful non-warrantable products. This is what we do and what you can do as best practices, right? So this is a collaborative effort. Everyone, loan officers, realtors, everyone in the condo department, this is what we need to identify. First, most importantly, verify the property type of the subject unit. Can't tell you how many times I get a question about something and it turns out it was a PUD. Planned unit developments are not subject to the same requirements as condos are, right? So all these critical repair guidelines that we've been talking about and different obstacles in guidelines don't apply to PUDs. Is there insurance? I mean, really, that's pretty much what we're looking at. So identify your property type as early in the process as possible to make sure that we're setting proper expectations. At the very, very least, provide the name of the association and city, state, and zip code. What does that allow us to do? Rate Companies have done thousands of condo loans, thousands and thousands of condo loans over the 14 years that I've been here. And we have a company internal database. And that applies to all Rate Companies, not just Rate, not just Origin Point, every company it's in this database. So we have far-reaching information that we can check to see, have we done loans in the project? Do we have documents that we can reuse? If we can reuse documents, then we're going to be able to speed up any additional loans in the project by reusing those documents. What work have we already put in? So by checking that internal company database will allow us to get as much information, if we have any, upfront as possible. And we look, is the project FHA approved? Is it VA approved? All of these guidelines that we've been talking about today apply to conventional standard agency guidelines. FHA and VA do not have all the same requirements in regards to condo project review that Fannie and Freddie have. So we could look at, is there an option to take this FHA? Is there an option to take it VA? These are those path forward and options that we would provide during a pre-qualification review. And importantly, on your conventional side, we will check the Fannie Mae approved and ineligible list and the Freddie Mac project databases to see if there's any information on there. So there's a lot of steps that go into what we provide during pre-qualification reviews, and these are just some of them. So anything that could be done on the sales side, on the realtor side, to provide us some information here to collect as much information and give you the best answers possible, it would be helpful helpful for us to be able to pre-qualify the project. So that with that being said, I'm going to go ahead and hand it over to Maddie, and she is going to talk about some non-warrantable products.
Woohoo, non-warrantable. More is less, right? Wink, wink. So when a project doesn't meet agency requirements, right, it's going to be considered non-warrantable. It's going to be called non-warrantable. And in fact, roughly 1 in 10 condo projects nationally are going to fall into this category. And so the really great thing about REIT companies is that we partner with a ton of non-QM, non-agency investors who are willing to finance these deals. My favorite phrase is they like to play in the gray. So I think somebody asked in the chat, one of the most common non-warrantable characteristics, and that's going to be right here on the page. These are the most common that we see and have seen through the 14 years that Amy and I have been doing this. But we actually have a handful of these investors, and commercial space is going to be the most widely accepted. And we have about a dozen investors at our disposal who will finance in these projects, almost up to 65% commercial space. It's kind of insane when you think about that. Super helpful in New York City, super helpful in San Francisco, right? Single entity ownership or low reserves is supported about around 10 of our investors. And on the stricter things like pending litigation, investor concentration, delinquent HOA dues, we have about 6 investors that will consider these. And then even on the rougher, most ineligible stuff, short-term rentals, rec leases, insurance, master policy deductibles, we still have about 4 or 5 investors who, allow us to lend in these projects. So, with non-warrantable condos, yes, there's likely going to be price rate adjustments, right? But these investors, bold, underwrite, italicized, capital letters, these are still opportunities, right? These allowances give us flexibility to our borrowers, your borrowers, right? So the key really is being in the details, right? And in the documentation, because as Amy said, if we know what's going on up front, if we know what we're working with, right, we're going to be able to align the project with the right investor and keep the deal moving forward. So that pre-qualification process that Amy talked about a couple of minutes ago is really, this is where we're going to shine. We're going to give you options, right? Every single option. You guys will determine, hey, does the borrower meet the credit profile criteria? But we will tell you, yep, you're good to go with these investors in the condo space. So that's all I got, Joanne. Thanks so much.
I was gonna say, that's all. Just all of that information.
That's
Is
all.
everybody
Yeah.
next? I think we do have 2 more poll questions. One we probably should have done a little earlier, but I think it would be good if we could just pull it up now, Natalie. It was like specific to what we think are the biggest pitfalls, I think, of condo financing. So yeah, again, from a sales, okay, so what is your biggest concern with working with condo buyers? And if you could only pick one, which one would it be? My personal thing has been deferred maintenance the last couple of years is where I've seen a lot of issues. And also as a salesperson, you also want to make sure you're doing what's in the best interest of your client as well, whether it's your seller, your buyer, your referral partners. And so it's just making sure that they're really educated and understand what they're purchasing, what they're getting themselves into from a condo standpoint. So mostly deferred maintenance, and a lot of people saying not understanding the process. And I totally appreciate that honesty there, because I think we did a pretty good job today of giving a lot of great information. The questions in the chat are amazing. Some of them that came up, I was like, normally I feel like I can answer all of the things, but there's a few in there that stumped me as well. So I know Amy and Maddie will take some time in going through that. And so that leads us to our last poll question, which is, after this call, do you feel like you have a better handle on working on the condo market? Yes or no? I hope everybody says yes. so much information, so many important things to know. Also, we would absolutely love feedback on what other Grow Mentorship Series calls that you would like to see. Condo is pretty much a regular staple every year, every other year, just because there's been so many changes, and it's a specialized market, but it's such a big part of the market in so many different regions. So it's important. But any other things that you want to know about, if you want just to have an insurance agent on, we did a book last month, Natalie, or the month before. So yeah, we have a lot of great things coming up, and we always would love your feedback. So you can just email grow@rate.com if you want to give any feedback. And if you are an expert in something and feel really passionate about joining us, we would love to have you on as well. Amy and Maddie are kind enough to continue to do this for me year after year and for you all. And so just thank you so much. I love it when I can leave these calls and say that I learned a few things as well. And I took some nice little notes here, and excited to see what the FAQ looks like after this as well. So Amy,
Me too.
Maddie, you're awesome. We love you. Thank you so much.
Thank you.
Thanks for having us.
And thanks for
Love
having
to be
us.
here.
Of course. All right, everybody. Have a wonderful Wednesday, and we'll see you next time.
Have a great day.